Hello, I'm talking about investment strategies with a number of my colleagues today. So, Ariel, how did 2018 go for you? What were the highlights and perhaps the lowlights?
So 2018 for us fixed income investors was a really challenging year. We had the first half of this year was very much a lot of concerns about rates, and we saw a decent backup in bond yields. And then the second half of this year, there's been a real pickup in concerns about credit risk. And so the credit markets have become a bit of a minefield. For us, we came into 2018 with a much more cautious approach, really with the view that the liquidity withdrawal by central banks was going to inevitably lead to a pickup in volatility. And so for a while now, we've been increasing the quality of our portfolios. And we're probably a bit early to that because asset prices were still pretty vibrant in the first 6 months of this year. But that cautious approach seems to now be playing out nicely for us in the second half of 2018.
I don't know whether we were quite as cautious, but actually we had a really good 2018, and just not so much in emerging markets, very little actually. Plenty in America in dollar-based assets, and plenty in good quality companies with repeatable earnings.
Well, I think the same thing's playing out in equity markets. So, it's all about growth and risk on in the first half of the year. Second half, it's about being much more cautious. And I think we're starting to see rotation back towards value. And so when you look at some of the areas of the market that performed well this year, a number of pharma companies, big oil companies have done well. And I suspect that, we may see something like that continue into next year.
Yeah, so within fixed income, sort of negative returns sort of across the spectrum, it's paid off to be cautious this year, particularly in credit markets, more so than interest rate markets, interestingly enough. Within credit, the best values come through from these sort of shorter dated high yield credit ideas where you've got a sort of a cash plus a little bit of return.
I would say that one thing that we've been telling our investors is that unfortunately volatility is here to stay in emerging markets. What we have seen during 2010 is a reverse of the flows from the previous 2 years. You had many investors chasing yield because you had negative rates out of Europe, very low rates out of the US, and they want some type of return. And as we see these flows going the other way, has created opportunities for us because it doesn't really matter if an investor has the best credit or sovereign in EM. They just want to be out. And for us, that has created opportunities.
Well, really the highlight for me was the launch of the flexible income strategy at the end of September. The low light was it coincided with the worst period of volatility since 2008. And certainly the flexible and dynamic nature of the fund was able to navigate through that. We've remained exposed to our core assets, high yields, some high quality equities, but we've really had to focus on portfolio construction and adding some hedges to really dampen volatility. But as we've gone through that period, we're estimated to be paying around 4.5% in euros, which I think is pretty attractive, and certainly in a zero interest rate environment is a meaningful pickup on many of those alternatives.
How's the outlook for inflation affecting the way you manage your investment strategies?
Yeah, so it comes through in a couple of ways for our fund, on our multi-asset fund. I mean, clearly we're playing the playbook we're playing is sort of late cycle dynamics, and in a late cycle we should expect some inflationary pressures to start coming through. I think we're not seeing much evidence of that yet, actually, in my view. However, I think the longer term dynamics are still, we're in this world of low growth, lower inflation. It impacts our fund through the fixed income holdings, clearly through the interest rate risk, but also through the correlation between the equities and bonds. So this sort of moderate sort of inflation environment is quite good for a diversified portfolio. But what would concern us is if you had much higher inflation, which would negatively impact both sides of the portfolio.
Yeah, I mean, I think when you look at employment levels in the UK, we've got record levels of employment. There's an issue around the productive capacity of the UK economy for sure. And on top of that, we've got sort of the rise of populism and governments trying to control salary levels, both from the sort of top down and from the bottom up. So we are starting to see evidence of margins coming under pressure for a number of companies from labour, as well as other issues like input costs for energy and other inputs. But I think we're certainly concerned that margins overall could be affected by a number of different factors over, for the foreseeable future.
So I'd agree that in the short and medium term, actually, particularly for the UK, we are concerned about inflation. And if you look at pub companies, those people that are very dependent on perhaps lower value labour, they're finding it more difficult to get hold of, and they're having to pay increased wages. And you're also seeing, I think they call it de-sheeting in the consumer goods sector, where you're getting companies that are giving you a product for the same price, but actually giving you less sheets per loo roll. I guess that Ariel might disagree about the inflation deflation aspects.
Yeah, we're very much on the other side of the trade. I mean, we think that the concerns about inflation is a bit of a red herring. If anything, in our portfolios, we've used the backup in rates as a buying opportunity to increase our duration and our exposure to, in particular, US Treasuries, which we think have backed up too much. We still think a lot of the powerful deflationary forces are still very much there. In addition to that, over the last few months, you're seeing money supply growth around the world now slowing down pretty sharply. The concerns for us when it comes to corporate profitability, yes, you are seeing a bit of wage growth. I would suggest that's going to impact profit margins because companies in today's world don't really seem to have much pricing power.
Well, volatility is here to stay. When we look at emerging market fundamentals, they continue to be very strong. We have inflation expectations that continue very well anchored. And while we have seen some central banks in emerging market increase rates, it has been more a result of trying to stay ahead of the curve of normalization of rates out of the US. So we're still very comfortable with the medium to long-term fundamentals in EM and of course inflation.
We've certainly seen inflation be relatively muted across the globe. I think that means that central bankers can be very, very slow and steady in terms of raising interest rates. And really they would argue that they're taking interest rates to normal levels rather than becoming very, very restrictive. What that means for our portfolio, it means that returns are likely to be positive but relatively muted. It means that those traditional sources of income of cash and government bonds probably unlikely to return back to those pre-crisis levels. So thinking more broadly about where those income sources are, I think is going to be important in 2019.
So more volatility in 2019. Are we expecting to see more volatility?
Yeah, I think we will see increased volatility. I think for me, it's all about central bank liquidity. That's been the key factor in driving asset prices to the levels where they are today. And that withdrawal of that central bank liquidity, which is now continuing at quite a decent pace, particularly by the Federal Reserve, who are now doing 50 billion a month of QT, or quantitative tightening, I think will exacerbate the volatility.
Yes, I mean, we all talk about volatility, and what we really mean is prices falling. Yes, I mean, I think in the short term you could see prices going lower, but I could also show you a chart that actually shows you as a long-term investor, say over 30 years, actually it really doesn't matter when you invest it. The critical thing is to stay invested and to make sure that you are invested in good quality assets that are going to stick around, so not flaky companies that are badly financed that may go to the wall. And actually the, in quotes, bad times are the times when good companies really take a step forward. They take over competitors that are having a tough time. It's a time of opportunity for investors.
I think for active managers, though, it's not just volatility, it's dispersion really that matters. In the UK, we've certainly seen a lot of both. In credit markets, we've started to see more volatility, but not much dispersion yet, I would say. And as we go into 2019, I think it's that dispersion that's going to really pick up in credit markets.
I think the other thing about QE is, it's probably extended the business cycle. And so as we see QT kick in, it's where are we really in the business cycle? And I think a lot of strategists, a lot of companies are kind of quite nervous that actually we're right at the end of a business cycle. And so we've got to kind of live with a world where things are going to get tougher from a demand perspective, and the kind of trade wars between the US and China are just feeding into those general concerns that people have about markets from here.
So obviously Q4 in 2018 was a very volatile period, not exceptionally so, I wouldn't say. I describe it as a move back to more normal levels. So we think vol probably increases. That's a normal environment. It means that thinking about portfolio construction becomes ever more important, particularly in a multi-asset framework.
So I have to totally agree with Talib. For us, the way that we manage volatility is through portfolio construction. And the four main levers that we have to do that is bond allocation, which of course is where do we put our money, which region, which country and sector. Also it's about duration. How do we manage duration and which point of the curve do we position? Also is our local currency exposure. Our funds are denominated in US dollars, but we have the flexibility to invest in local currency. And last but not least is cash. We always get the question, why is cash one of those four main levers? And while of course you don't make any money in cash, you also don't lose any money. And for us is to have the opportunity to take advantage of market dislocations to find what we think are cheap assets.
Does Brexit affect the way you think about investing in 2019? And if so, how?
Certainly does for our fund, which tends to have a bit more of a UK core focus. It's been a big issue in 2018 and certainly looks like it will be into the start of 2019. I mean, the way we've looked at it, we've taken a number of sort of top-down decisions through options on equity indices, as well as sort of using our flexibility on the currency side to help try and manage some of that volatility within the fund. But I think against that, what we're starting to see is some really interesting opportunities. We see that on the equity side, but also on credit, where you're seeing, I talk about dispersion, but there's a lot of dispersion between the UK and other credit markets, the US, for example. We're seeing a lot more value coming through in the UK market.
I mean, it's, really investing is all about what's priced in. And, if you're a global mandate, you just haven't had to be interested in the UK at all for, the last 2 years almost. And so you can just sit on your hand and park it as an issue. Hopefully in the next few months, we are going to have some certainty. And on that basis, I think a lot of international investors aren't just going to be able to sit there, because there will be potentially the opportunity to make quite a lot of money in the UK. And it's really, again, about what's priced in. So even in a bad scenario, if share prices tumble, but we know what the outlook is, there may be an opportunity to make a lot of money. But, in that bad scenario, you've got to assume that there's going to be some kind of recession in the UK, and what is likely to happen to earnings in that kind of situation, and what is priced in on those kind of lower earnings assumptions. But I think there are a lot of very good companies in the UK, and everything's being put into one basket at the moment and completely shunned, and there will be opportunities to cherry pick the best ideas, I think.
I mean, I have to say we've been rather more sanguine about Brexit. We look at the UK economy and think it's actually been doing pretty okay. As global investors, as Alistair says, we have been able to perhaps sidestep the issue a little bit, and certainly having dollar exposure particularly has been helpful to sterling investors. I think the UK economy is something like the 5th biggest in the world. I don't think we should be too scared as investors, and in fact we should take the opportunities that are arising.
From our perspective, we're pretty fortunate. We are a global fund, so we don't have to be in the UK. But where we are, it's typically to the more defensive sectors where we have exposure and typically short duration paper. And also we still quite like the banks, which we have done for quite some time. They've done a really good job of recapitalising their balance sheets. And so we're happy to lend at a subordinated level there. Yeah.
So perhaps the key question next year is not, funnily enough, Brexit, but the relationship between the two global superpowers, the US and China. How do you think about that, Alejandro?
That to me is the main risk for 2019. What started in the US as a campaign promise to tackle trade deficit has morphed into something much bigger than that with China. You have the US administration accusing China of meddling in the elections, of stealing intellectual property. Well, I think for China has been more simple. They want to maintain the status quo. And to achieve that, of course, they have the big plans of One Belt, One Road strategy, and of course, Made in China 2025. As an investor, we need to keep a very close eye how the Chinese will be able to balance this growth of reaching of close to 6.5% and also the relationship with the US.
I'd agree that that China point really is a strategic thing which we're going to be analysing for many years, much more than what a car tariff is going to be next month or the month after. There's really a very long-term game going on there. But taking a step back, I think the other thing that's changed is we're in a period of deglobalization. For the last 30 or 40 years, we've seen an expansion of trade, capital and people flows. And I think that potentially is moving into reverse as we look through 2019 into 2020. And I think that has some profound implications for the way industries are constructed, some of the investments across emerging market equities. Many of those trade-related economies, I think, are going to have to restructure, and that's going to have profound implications going forward.
Well, thank you, gentlemen. Really interesting discussion. And I wish you all a healthy and prosperous 2019. Thank you.